As of this exact moment, Beyond Meat, trading under the ticker BYND, is sitting at a precarious $0.86, that is, 86 cents. In today's intraday session alone, we are watching the stock bleed out another 1.8 to 2%, fluctuating in a tight, suffocating range between 81 cents and 88 cents. If you are looking at the chart, you are seeing a slow, grinding descent that feels less like a correction and more like a suffocation. The market cap has withered down to roughly $390 million, a figure that would have seemed like a typo just a few years ago when this company was the darling of Wall Street. But here we are. The expectation from the retail crowd, the casual observers scrolling through their brokerage apps, is that a stock trading under $1 is a lottery ticket. They see 86 cents and think, if this just goes back to $5, I make a fortune. That is the expectation, a bargain bin opportunity with unlimited upside. The reality, however, is far more brutal and far more complex. What you are looking at is not necessarily a discount, it is a distress signal. The price action today isn't just market noise. It is the market pricing in a fundamental restructuring of the company's existence. While the average investor is hoping for a bounce, the institutional money is looking at the recently approved increase in authorized shares from 500 million to 3 billion, and they are doing the math. That is not a typo, 3 billion shares. When a company authorizes a six-fold increase in its share count while the stock is trading under $1, they are not preparing for a victory lap. They are preparing to flood the market with paper to keep the lights on. This disconnect between the cheap stock narrative and the dilution machine reality is where retail investors get crushed. And it is exactly where we need to focus our attention today. Let's talk about what is actually moving the stock right now. You might have seen the massive volatility in October 2025, just last month, where the stock seemingly woke up from the dead, rallying on news of Walmart distribution expansions and getting swept up in a meme stock ETF inclusion. That rally sent shares flying, creating a classic short squeeze setup that trapped a lot of bears. But look at the aftermath. We are back below $1. Why? Because the fundamentals of the business did not change, only the liquidity mechanics did. The smart money used that liquidity event, that spike in volume, not to buy in for the long haul, but to exit their trapped positions or to initiate new, fresh short positions at higher prices. Today's slide to 86 cents is the hangover from that party. The volume we are seeing today is relatively mute compared to those explosive days in October, which suggests that the aggressive buyers have left the building, leaving the stock to drift lower on the back of algorithmic selling and lack of bids. This brings us to the elephant in the room, short selling. You cannot talk about Beyond Meat without addressing the massive short interest that has defined this stock's trading personality for years. Right now, short interest remains elevated, but the dynamic has shifted. In the past, high short interest was a bullish signal to the ape community because it meant a squeeze was imminent. But you have to look at the days to cover and the borrow fee rates. When a company is in danger of bankruptcy or massive dilution, which is the signal sent by authorizing 3 billion shares, short sellers are not scared, they are emboldened. They are willing to pay high borrow fees because they believe the stock is going to zero or that the company will issue so many new shares that the price will naturally, mathematically collapse. If you are holding the stock hoping for a squeeze, you need to understand that the company's own management has effectively handed the shorts a get-out-of-jail-free card by creating the potential for massive dilution. A squeeze requires a lack of available shares. Beyond Meat just authorized a mountain of them. Actionable insight time. If you are tracking the short data, do not just look at the raw percentage of float shorted. You need to look at the fail to deliver data. When you see a spike in fail to deliver, It often signals that market makers are having trouble locating shares, which can lead to a temporary forced buy-in. However, with the new share authorization, the supply constraint is theoretically gone in the long term. If you are playing this for a bounce, you are trading against a management team that needs to sell stock to pay off convertible debt. The smart move here isn't to blindly buy and hold, it is to watch the borrowing cost. If the cost to borrow shares suddenly specs to triple digits again, you might see a temporary, violent rally, a dead cat bounce. But buying this stock right now without a strict stop loss is akin to catching a falling knife. Now, take a second and comment below. Do you think the plant-based meat trend is just in a winter cycle that will pass? Or was the whole industry a zero interest rate phenomenon that is never coming back? I want to hear your take on the macro sift. Let's shift gears to the business itself, because the stock price is ultimately a reflection of the company's ability to generate cash. The Q3 2025 earnings were, to put it mildly, a disaster. Revenue came in at $70.2 million, which was a decrease of over 13% year over year. But the scarier number was the net loss, $112 million. Think about that ratio. They generated $70 million in sales and lost $112 million doing it. That is a sustainable business model only if you have an infinite bank account, which Beyond Meat does not. They are burning cash at a rate that makes bankruptcy a legitimate discussion for 2026 if they can't turn the ship around. They are caught in a pincer move of economic pressure. On one side, inflation has made groceries expensive, and when consumers are tightening their belts, they switch from expensive premium fake meat to cheaper real meat or just beans and lentils. On the other side, the company is stuck with high fixed costs and a massive debt load that needs to be serviced. The narrative used to be that Beyond Meat was a technology company, not a food company. Investors paid a premium because they thought they were buying the Tesla of food. The reality check we are living through now is that Beyond Meat is, in fact, a food company, and a food company with negative gross margins is a crisis. The recent strategic pivot to discontinue the jerky line and focus on the core burger and beef products is a sign of them trying to stop the bleeding, but shrinking your way to profitability is a very difficult game to play when your revenue is already dropping double digits. They are losing shelf space. If you walk into a supermarket today compared to 3 years ago, the plant-based section has likely shrunk. Retailers are ruthless. If a product doesn't turn over, it gets cut. Beyond Meat is fighting a war on two fronts, convincing consumers to come back to the category and convincing retailers not to delist them entirely. We also need to discuss the reversed split risk. The shareholders approved the proposal to allow the board to effect a reversed split. This is usually the kiss of death for a stock's momentum in the short term. A reversed split, say 1 for 10, would take the price from 86 cents to $8.60. This sounds fine on paper, but in practice, it usually attracts more short selling. Short sellers love shorting post-reverse split stocks because the higher price gives them more room to ride it down again. If you are holding shares now, you need to be acutely aware that a reversed split announcement could trigger a sell-off from retail investors who hate seeing their share count decimated, even if the value technically stays the same. It's a psychological blow that often precedes further downside. There's also a massive disconnect in the sentiment online versus the sentiment in the boardroom. If you go on X or Reddit, you'll see people trying to rally the troops, talking about how the hedgies are suppressing the price. But if you look at the filings, the suppression is coming from the balance sheet. The convertible notes due in 2027 and 2030 are a ticking clock. The recent debt restructuring bought them some time, but it came at the cost of massive potential equity dilution. The bondholders are essentially converting their debt into equity, which means they are becoming sellers of the stock. When your debt holders become your shareholders, they rarely hold for the long term. They sell to recoup their principal. This creates a constant overhang of supply that rallies struggle to break through. However, let's look at the contrarian case, the reality exceeds expectations scenario. Is there a world where Beyond Meat survives? Yes, the brand name is still the strongest in the category. If the global economy shifts, or if they can successfully penetrate the European market more aggressively, where the acceptance of plant-based diets is stickier, they could stabilize as a smaller niche company. The McDonald's McPlant experiment was largely a bust in the US, but international partnerships remain a lifeline. If they can get their cash burn down to zero, meaning they stop losing money on every burger they sell, the stock is incredibly cheap at $390 million market cap. A company with $300 million in revenue that is break-even is worth more than today's valuation. The bet you're making at 86 cents is not that they will return to all-time highs, but that they will simply not die. It's a binary option: $0